So this morning we'll be talking about convertible bond. Convertible bond. We have straight bond. That is bonds that cannot be converted. And we have bonds that can be converted. These are bonds that comes with option of either you changing it to shares or to cash. So when we talk about convertible bond, when we talk about convertible bond, a convertible bond is a type of bond that gives the investor two benefits. Two benefits. That is debt investment and equity conversion option. So with debt investment, the investor receives interest and gets the principal back at maturity. With equity conversion as an option, the investor has the right to convert the bond into a specified number of the company's ordinary share. So when you are served with a question that has to do with convertible bond, there is a rule to the conversion. At the maturity period, the rule is that you compare what is the redemption value. The redemption value will be the higher of the cash redemption value, that is, if not converted, or the higher of the share value on conversion. So what we are saying is this: with convertible bond, when you are solving a question, the value of the bond, the value of the bond, the value of the bond at redemption, that is at maturity period, and the value when converted. When converted, the greater of the two is what you are going to work with as the redemption value. Now, the value when converted to either what? To either cash or share. Now, what is the par value, the face value of the bond? You compare these two. Whichever is higher will be what you will have to use as your conversion value. Now, the question is this: the value of a convertible debt. Okay, let's say the higher of the two above, of any of the above. Now, the value of convertible debt, this convertible debt is what? Comprised of what? Comprised of debt and what? And equity. It means with convertible debt, you have the option. You have the element of debt and equity. That is equity conversion option. Equity conversion option. Now, looking at this convertible debt, the conversion means that the investor can give up the bond and receive what? Ordinary shares instead. So when you want to convert or get the value of your equity, when you want to get the value of your equity, the value of your equity, that is when you want to get the value of your equity in the question, they will not give you the value of the shares, of the whole shares, but they can give you the current share price. They'll give you the current share price, and also they will give you what? The conversion ratio. The conversion ratio will be what? The number of shares. The conversion ratio will be the number of shares in the question. Let me put that. That's the conversion ratio. The conversion ratio will be the number of shares. For example, let's say we have 50 shares. That is, one bond is equivalent to, or 1,000 Naira bond is equivalent to 50 shares. And the value of one share price, let's say is 16 Naira. Is 16 Naira. Now, what will be the current value of the shares that you can obtain through conversion? The value of the shares will be what? The value of the shares will be what?
800.
Yes, 800. That is 50 shares multiplied by what? 16 Naira, which will give you what? 800 Naira. Now, you can have a case where there will be a growth, where there will be a growth in the value of the shares. Some question will just give you the share price and conversion. Some question will tell you that they will tell you that there is growth. There is growth in the value of the shares. That is, the share is expected to appreciate per annum at a particular value. When there is growth in the value of the shares, what are you going to do? It will be where there is growth, where there is growth, it will be equal to what? It will be the share price, to be the share price multiplied by what? 1 plus what? Plus G to the power of what? N. 1 plus G to the power of N. So now, let's assume that the value of our bond is 1,000 Naira. At the current share price, when you convert 1,000 Naira bond into shares, it will worth how many shares? It will worth how much? 800 Naira. Because the value of the shares equivalent to 1,000 is 50. So what will be the money value compared to the value, the face value of the bond? 1,000 Naira compared to 800 Naira. Is this attractive? Is this option attractive?
No.
It is not attractive. It is not attractive. But suppose the share price is 30 Naira. Suppose the share price is 30 Naira and you have it as 50 multiplied by 30. This will give you what?
1,300.
1,
1,500.
to give you 1.5. So this makes the conversion more attractive. Now, why is it that investors might want to go with 800? Investors might want to go with 800 because it's giving them a conversion option. It's giving them a conversion option. because it is not, it is flexible. It is flexible. Now, we can have a case of straight bond. Straight bond. In straight bond, it is solely bond. There is no dilution of the bond. But with convertible bond, there is dilution. But with a straight bond, there is no dilution. It is solely what? The bond. It is solely the bond. So now the company gets an important advantage when it is what? A convertible bond. The company will pay a lower interest rate. But when it is a straight bond, that is, there is no dilution, the company will pay a higher interest rate. So with that, investors will accept lower interest rate because they are receiving something valuable in return. There is a trade-off. Yes, I'm getting a lower interest rate at the expense of something. And what is that trade-off? Instead of getting a higher interest rate solely based on debt, they are going for convertible debt because they have an option to convert. And where are they going for this conversion? When the share price increases, they can easily switch to share option. So the conversion option, with the conversion option, the investor will be willing to accept lower interest rates or lower interest because the investor has the opportunity to become a shareholder if the company's share price rises. So the point is this: with convertible debt, there is a lower coupon for investor, which is exchanged for potential capital gain in share price in future. So when we have a growth, it is computed as what? Share price multiplied by 1 plus g to the power of n. The n is the number of years that the investment will last. So now, with convertible bond, now I'm trying to make some distinction between convertible bond and straight bond, because in some question you see straight bond, you'll now be wondering, what is this straight bond all about? Is solely bond without any dilution, without any dilution. Now, when you look at most questions that has to do with bond valuation, even cost of capital, you will discover certain things. You will discover the issue of credit rating. Credit rating. This credit rating, those basis points, they are credit rating. Now, when you talk about credit rating, put it down. In SFM question, you cannot run away from the issue of credit rating. You definitely see them in at different points in your question. Credit rating. This credit rating is how well an organization is doing in relation to their financial health. This credit rating, if you listen to business news very well, you will see the newscaster using this word, especially when it comes to business news. You see them using basis points, using AA and the rest. So credit rating is an assessment, of how likely an organization is to repay is to repay its debts and meet its financial obligation. And meet its financial obligation. Financial obligation on time. So credit rating tells lenders, tell those that want to help you with some funds, with some finance. It tells investors how risky it is to lend money to an organization. So an organization with a high credit rating is considered what? Relatively safe. While one with low credit rating is considered what? More risky. Now, a credit rating is a financial indicator, is a financial indicator to potential investors of bonds, to those who want to invest, telling us that this is how this organization is. That by the time you put your money in this organization, your money is safe. But where the credit rating is low, it shows that the organization is highly susceptible to risk. So with credit ratings, we have some agencies that are saddled with the responsibility of rating organization based on their financial statement. Now, the well-known bond rating agencies internationally, we have the Moody's and we have the Standard and Poor. These agencies rate countries, rate organizations based on their financial performance. Now, this issue of AA, you see some organization being rated as AA, some will be rated as AA plus, some will be rated as what? AA minus, some can be rated as what? A plus, some can be rated as what? Some can be rated as just A, some can be rated as A minus, while some can be rated as what? BB, BB plus, some can be rated as just BB, some can be rated as what? BB minus. We can have some can be rated as what? BB plus, some can be rated as what? BB, some can be rated as what? BB minus, some can be rated as just B plus, some can be rated as what? As B, some can be rated as what? B minus, in that order. Even some can be rated as CC, some can even be rated as CC, some can be rated as just C. What is the meaning of all this? Now, for AA, for an organization that is rated AA, the implication is that the implication of AA is that the obligor, who is the obligor? We're talking about obligor. Who is the obligor in this respect? An obligor is a person, or I can say an obligor is a company or organization that has legal or financial obligation to another party. So in this case, when you have AA, it means that an obligor, it means the person you've lent money, the borrower. Or let me use the word obligor from the word obligation. An obligor has what? Extremely, that is when it is rated AA, has extremely strong capacity extremely strong capacity to meet its financial commitments. To meet its financial commitments. To meet its financial commitments. I'm trying to explain this so that when you see AA, BB, you'll not be asking yourself, what is all this? It is just a way to rate organization on how well they can meet up with their financial obligation. So as an investor, when you see an organization rated AA based on international standard, it means this must be a reputable organization with sound financial footing and stable financial status. So when you see some organization being rated as AA plus, it means that AA plus, they are very strong. It means that the obligor has a very strong capacity to meet what? Its financial commitment. So it differs from AA, that is the triple A. It differs from the triple A because it differs from the highest rated obligor only to just a little degree, only to a little or small degree. So this AA, BB of a thing is a way to evaluate an organization in terms of what? Their credibility, in terms of what? Their credit worthiness. Their credit worthiness. So now, when you see an organization with B, the implication is what? The obligor has adequate capacity to meet its financial commitment. But there is a but. An adverse economic condition or changing circumstance may likely weaken their capacity. So it means that little unforeseen circumstance can affect their credit worthiness, can affect their credibility. So as investors, when you want to invest, you are likely to consider grade B to A as a high level point where you can invest your money. These are investment grade points, especially these B, triple Bs, and As. But when you are now moving to just the double Bs, moving to single Bs and C, it shows that you must be very careful. Organization with the double Bs, it shows that the obligor is less vulnerable because it has a lower rated credit rating. So one thing with these companies that find themselves at this point, due to their financial statement, it shows that certain major ongoing uncertainty or exposure to adverse business situation, financial or economic conditions can lead them to not meet up with their financial commitment. So it means they are vulnerable to economic conditions, to adverse business, and so on and so forth. So the point is just understand that when you see AA, BB, they are just level of credit worthiness of an organization. Let's note that, please, so that you will not be asking how did they come about BB, CC, and the rest. The reason for that explanation. Now, moving back to the subject matter, convertible bond, let's look at an example as it relates to this. Example one. Example one. let's say SYZ 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 Limited has a convertible bond, that may be redeemed, at 10%, premium to par value, 10% premium to par value in 4 years. The coupon is 8%, and the current market value is 110 naira. Alternatively, the bond may be converted into 25 ordinary shares. 25 ordinary shares So the current market value, of the share is 5 naira, and are expected to appreciate in value by 2% per annum. Calculates the costs of the convertible debt, of the convertible bond, So this is a question in relation to bond. So the first thing we are to determine, what will be your coupon value? Your coupon value will be what?
8 naira.
The coupon value will be 8 naira. And for you to get your coupon, the coupon rate is what? 8% multiplied by the face value of bond. The face value of bond is 100 naira or 1,000, where it is stated that it is 1,000. So the face value is 100. So your coupon value will be what? Will be 8 naira. Haven't determined your coupon value. What is the current value of the bond? The current value of the bond is what?
110.
110 is 110 naira. Now, what will be our conversion or redemption value at maturity?
110. It's at
110.
premium.
Okay, look at the question very well. What do we
10%.
Okay, we explained something about convertible bond, right? That at maturity, you compare two things. What are those two things?
Redemption value and the conversion value.
Very well. Yes. So looking at this question now, the redemption value of the bond is what? We'll compare the two, whichever is higher.
10%.
Redemption value,
Conversion value is 110. It's at
okay.
premium.
Okay,
So
110.
that's for the redemption value.
Yes.
Why conversion
Redemption
value is 125 naira.
125.
125 naira. Yes.
Okay. Have you considered the growth, sir?
No.
So redemption value is 100 naira
And I was
multiplied by what? 1.1. Because the question says that what? The question puts it that what? Will be redeemed at a premium of 10%. So 10% above the face value will give you what? Instead of doing it the primary school way, where I will say 10 over 100 multiplied by 100, I will get what? 10. I will now say 10 plus 100. That will give me 110. I can just say 1.1 multiplied by 10, and I'll have what? 110. Now, based on the share value, if you look at the question, how many shares are you converting?
25 share.
25 shares. 25 shares. The value of the share is what? Of one share is what?
5 naira today as today price.
Yes, 5 naira. And it is expected that the value of the share will do what? Appreciate.
Yeah.
By what percent?
2%.
2%. What is your formula when you have the groups?
That's price open brackets 1 plus growth rate raised to power n, which is the number
Yes.
of years.
So this will now be multiplied by what? 1 plus
Point.
the growth rate is 2%, 0.02 to the power of what? How many years are we looking at?
4 years.
4 years.
4 years. So when you do these mathematics, what will be the result?
135 naira 0.30.
135.30. Now, comparing this redemption value with the share value, which is higher?
Conversion value.
The conversion value of share is what is higher. So at the redemption date, at the maturity date, you are going to use what? This higher value. This higher value. So that is the essence of convertible bond. You compare the two options, whichever is higher, that is what you're going to use at the maturity date. That is the rule. And the point is this. Okay, let's just show the workings. Let's show it. So the question is telling us to do what? To calculate the cost of the convertible bond. So who can tell us the step? Since we're talking about the costs now. The cost of convertible bond.
Use IRR.
a cost. Okay, yes, we use internal rate of return, cost of convertible bond. So I'll be using one table for the two discount factor that we'll consider. I think at this point we are so used to IRR now that we shouldn't find it confusing again. So we're going to have our year. We're going to have what? The details. The details, say the value, your discount factor, the present value. So we have to assume two discount factor where one will give us a positive MPV and one will give us a negative MPV. So can anybody suggest, so that I will not be the one to be giving it
Let's use 510.
510? So first, let's assume 5%. Assume 5%. So for year zero, what will happen? The current value of the bond is what?
110.
110. Negative. Your discount factor at year zero will be 1. So your present value will be what? Negative 110. Now, for year 1 to 4, since we have same amount or same value as coupon, as interest, annual coupon, we can use our annuity formula. Now, your annual coupon value is what? It's 8 naira. 8 naira. Since we're using 5%, using your annuity formula, what will be your discount factor using 5%? So your annuity is 1 minus what? Open brackets. 1.
3.5, 3.460.
Okay, 3.460. So I believe everybody
Sorry, sir,
knows
it's 3.55.
3.54.
3.5459. So it's 3.55. We are doing 2 decimal places.
3.55. So 3.55 multiplied by 8, we have what?
28.4.
It's 8.4. Now, please take note. You know, this year 4, you can solve it in 2 ways. Is either you include your coupon with year 4, with the redemption value in year 4, or you solve it independently. What we've done here, the coupon have been cumulated with year 1 to 4. So that of year 4 is already here. Some persons can decide to solve by adding year 4 coupon to what? To the redemption value. To the redemption value. You still arrive at the same results. I'm saying this because when you can see different solutions in diverse ways, but all will lead you to the same result. So at year 4, the conversion value is higher. So we make do of it. So the value is what? The higher of redemption and share price.
135.30. 135.30.
135.30. 135.30. So your discount factor just for year 4 alone will be what?
0.82. 0.82.
0.82. When you multiply by 135.30, you have what?
110.95.
110.95. Your MPV will be what? MPV
29.35 positive.
Okay, 29.35 positive. So to get a negative MPV, what are we going to do?
We increase the discount factor.
Increase the discount factor. When we increase this discount factor, can you do a rough work? Use 10%. Let's see. You know, you try and error approach. Do a rough work. Use 10%. Will it give us a negative value? Because what I'm seeing it that it might not give us.
No, it's giving us positive.
Positive, very good. So I'm already seeing it, that it will not give me a negative. So can we increase it to 15%? So now,
10% is okay.
okay, fine. So discount factor at 15%. So for this, in year 0, to still be 1. I'm using one table for both instead of splitting it. So your present value will be what? 1 times 110. You still have 110. So using 15%, annuity, 15% will give you what?
2.85.
Okay, 2.85. Multiply by 8. Your present value will be what?
22.8.
22.8. For the fourth year, using 15%,
0.57.
0.57. Multiply by 135.30. We have what?
77.12.
77.13.
1
Your
2.
MPV,
1 2.
okay, 1 2. So your MPV will be what? The MPV will now be what?
10.08 negative.
Negative 10.08. So when you substitute these values into your internal rate of return formula to get your cost of debt, what will that be? Let me borrow this formula here. So when you substitute into the IRR formula, cost of debt, the lower value is, okay, 5. And the value here is 29.35. The value here is 29.35 minus 10.08 to give you plus 10.08. 10.08. This will be 15, the higher value, and your cost of debt will be what? What will be our percentage?
12.4.
12.4%. 12.4%. 12.4%. 12.4%. So 12.4% will be your cost of debt. Be your cost of debt. The essence of this example is to make us understand the value to use at the maturity date. The higher of the redemption value or the conversion value. Let's test our understanding with this question. Before we move to the question I forwarded to the group, that's ABC Limited has 8% convertible bond, which are redeemable in 5 years. Which are redeemable in 5 years. In 5 years time at their nominal value. At their nominal value of 100 naira. Of 100 naira per bond. Okay. So alternatively, each bond could be converted after 5 years into 70 equity shares. With a nominal value. Of 1 naira. Of 1 naira each. The equity shares of ABC PLC are currently trading at, say, 1 naira 25 kobo. 25 kobo per share. And this share price is expected to grow at 4% per year. What is the market value? What is the market value of the bond? So you have to be careful. Don't go and do copy and paste with what we've done before. In that example, they are asking us of what? Cost of the bond. In this case now, they are asking us of what? The market value of the bond. So now, can you solve? Yes, what is the answer? Hope we are solving. Omi Adenike,
106. 106.446.
106. Is that your final answer?
For the value of a convertible bond,
Okay. So once the final answer, what are we going to do?
we go with the bond. We go with the bond. The bond value is 108 at redemption. Then convertible bond at redemption. Convertible option is 106. So we go with the bond, the value of the bond.
Okay. That is 1.05 to the power of 5. 0.04 multiplied by 1.25 multiplied by 70. The share is giving me 106. Then the value of the bond,
The bond is 108.
108.
I got 106 for the convertible bond.
Okay. 5 years time at their nominal. Mr. Friday, the bond is redeemable at what? In 5 years time at what?
Nominal value.
Of
Nominal
what?
value.
Of what, sir?
100 naira.
100. So
100 naira.
comparing it with 106 of the share conversion, which is higher?
Okay,
106.
106 is higher. 106 is higher.
Yes, 106 is higher. Though you are giving me the right word, but the explanation to you are giving me the right figure, but the explanation to that figure is what we want to correct. So, yes, you have 106, man. So, what would be our final answer?
106.
Final answer. Okay. Madam Chidima, you just
Yeah.
joined. Uh-huh. You are still busy at home.
No, I joined late. I forgot the class.
Yeah, it's weekend, so I need to take part of your weekend. So looking at the question, I'm expecting everybody to be able to solve. Comparing the value you will use at redemption. Bond redemption value. Redemption value is what? 100 naira.
400.
The conversion value is what?
106.
You have how many shares? 70. Multiplied by what? The value of one share is what?
1.25. 1.25.
Into the bracket of what? 1 plus the growth value is what? 4% plus 0.04 to the power of what? How many years? 5 years
5 years.
to the power of 5. When you solve this, you have what?
106.5.
106.45. So this will be the conversion value. So which is higher? 106.
The
The
conversion
question
value.
is asking us to determine the market value. I know in this class, some persons are still confusing market value and costs of the debt. We are still in confusion when they say calculate the market value of the bond, calculate the cost of the bond. Who can give us the difference between these two things?
For the cost of the
The-
bond, you start with year 0, but for the value, you start with year 1 to 4.
Yes. So for market value of a bond, the market value is the amount the bond is currently worth in the financial market. So you start from what? From year 1. What is the price?
I got 104 for the market value.
Okay. 104. That is
No, not the conversion, not the redemption value. I mean the market value.
okay. That is your final answer.
Yes, sir. Yes, sir.
Okay. We'll see that if we are correct. So the market value is the amount the bond is currently worth in the financial market. So it is the price at which what the investors are willing to pay, willing to buy or sell the bond, while the cost of the bond is the return required by the company for using the bond finance. So the return you are expecting, what is the costs associated with it? And that is that coupon we are always computing, the interest. So please, let's note that so that when you see a question, you know how to solve for market value, you know how to solve for cost of the bond. It's very important. So now we have our year, we have our cash flow, we have our discount factor, we have our discount factor, and we have our present value. We have our present value. So in this case, what rate are we going to discount with? What
8%.
the rate of discounts? We're going to discount with what rate?
8%.
8%. 8%. So for year 1 to 5, it will be what? For year 1 to 5, we'll have it as
3.9.
what? Your cash flow is 8. The discount factor will be what? The discount factor will be what? Year 1 to 5.
3.99.
And your present value will be what?
$31.92.
And at the 5th year, your cash flow will be what?
$108.
As 1.05 to the power of what? Minus 5 should be, okay, that is 1.08 to the power of minus 5.
0.681.
0.68. Okay. Using 2 decimal places. Multiply by 106.45. So we have it as what?
72.9.
39. So your MPV will now be what? That's 1.92 plus what? 72.39. So say you have 104 point what? 0.31. 104.31. Now, going by the question that we have on the group, that is May 2017, question 4. May 2017, SFM, May 2017, question 4. I'm not mistaken. Let me bring up the question. But if you have the question, you can read on the WhatsApp group. Hello, can you hear me?
Yes.
All right. If you have the question, you can read. And try to come up with a question. Yes. Somebody should read, please. If your environment is not noisy, that is the condition. Yes, anybody?
Yes.
So read ma.
You are a financial consultant to a major company based in Kano. The company plans to build a major warehouse in Abuja. You plan to convince the company's manager to raise the need funds through a convertible bond issue. Based on company's current bond rating of triple B, you have projected the following offer terms: maturity 6 years, annual coupon 1%, conversion ratio 50 shares, per value per bond 1,000 naira, issue price 98% of per value, current stock price 16 naira, risk-free rate 0.5%, coupon on strength bonds 2%, trading at par. The proposal suggests raising up to 20 million naira. However, with key financial ratios close to the boundaries of rating category, offering the full amount could threaten the triple B rating. Given an average business risk profile, the following rating guidelines apply. Rating category: triple B, minimum interest cover 2.39, default spread 0.5%, triple B minus 2.05, default spread 1.0%. Selected financial data about the company. Estimated earning before interest and tax 2,200,000 naira. Current interest expenses 800,000 naira. Required AI. Determine the value of the convertible bond offer. II. Discuss why the convertible bond cannot generally be considered as cheap debt despite its low coupon, given its financing advantage quantified in economic terms. BI. Compute the company's current interest coverage ratio. II. How much money should be raised with the convertible bond issue in thousands of naira in order to avoid the threat of a rating downgrade based on the quoted rating guidelines. C. Advise the company on the advantages of convertible bond for companies on one hand and for investors on the other hand. Thank you.
All right. Thank you, ma. So
Welcome.
when you see this question in the examination hall, what will you do? Hope you will not put your hand in your head and say, Ewo.
You first drink water.
Okay, you drink water. And to your surprise, you discover that the solution is just something that is not more than, especially for the A part that I'm so concerned about, is the solution is just something small. And it's something you know. Yes, something you know. So let's see how to analyze this question. Now, the value of convertible bond is what? For you to get the value of convertible bond, what are they asking us to do? Is it the cost of debt or the market value they want us to determine? Let's ask ourselves.
The market value.
Market
The
value.
market value. Fine. The market value. The market value. So the value of the convertible bond is the present value of the future cash flows. Now, what are the future cash flows? That is the question. What are the future cash flows? Can I get the response?
Yeah, the coupon payment and the difference between the conversion value and the redemption value, the higher of the two.
Yes, those are the future cash flows. And Once you get that, it will be discounted at the rate of return of the bond. So in this question, the investor has the option to exercise his rights, either to convert or to still remain with the bond value. So now, let me come up with my own analysis of this question. So you all have the question. So I'm going to move to the solution page. So I will just do my own breakdown of the question. So calculating value of convertible bond. Calculating value of convertible bond. I'll write my little story so that everybody can understand. Say that the value of the convertible bond is the present value of the future cash flows. When we talk about the cash flows, we are referring to what? The coupon. That is your coupon payments and the conversion price or the redemption value, whichever is higher, said. So this will be what? Will be discounted. Will be discounted at the rates of return of the bond. The rate of return of the bond. But however, the investor will only exercise the option to convert. That is if and only if it is profitable. If it is profitable, to do so. So the investor will select the higher of either the redemption value or conversion price. Now, going by the question, what will be your redemption value? The redemption value will be what?
1,000.
The redemption value will be 1,000 naira. Now, what will be your conversion value? In this case, there is no growth. So you should work direct, isn't it? There is no growth. So when there is no growth, This is the concept that we've shown, right? Just straightforward. It will be what, sir?
800.
It will be 800. How many shares do you have?
50 share.
50.
50. That is the conversion ratio, 50 shares. So 50 shares, the value of one share is what?
16 naira.
16 naira.
16 naira. So when you multiply, the conversion value will be what? 800. So it is very clear that at maturity, you will go with which value?
The redemption value.
The
Redemption
redemption value. You can see it's not difficult. Coupon. Your coupon will be what? Going through the question, your interest is what? Your annual coupon value is what? 1%.
1%.
So 1% multiplied by what? The face value. You have it as what? As 10 naira. The maturity period is what?
6 years.
6 years. Maturity is 6 years. The current market value of the bond is what?
980.
980. Current market value. Current market value is 980. Is 980. How do you get 980? You check the question. Issue price.
98%. Okay, 98%
Of the face value.
98% of the face value of 1,000. This will give you 980. To give you 980. To give us 980. Going through the question, we have risk-free rate. Risk-free rate. The risk-free rate is associated with what? This risk-free rate is associated with what?
The credit spread.
Yes.
The yield to
Why?
maturity.
Okay, right now, sir. Is associated with the credit spread. But why is it associated with the credit spread? The risk-free.
Every government bond always associated with credit spread.
So,
Zero coupon rate.
so the bond which is having the risk-free rate of 5%, of 0.5%, will be associated with the spread. With the spread. If you look at why we were treating adjusted present value, you will see the effect of the basis period in relation to what? To the value of the bond, to the value of debt at that point. So this risk-free rate of 0.5%, it is in relation to what? To the default spread. And the default spread is what? The default spread is for BB, the rating category, because in the question, it is stated that what? The proposal suggests raising up to 20 million naira. That, however, with key financial ratios close to the boundaries of the rating category. Offering the full amount could threaten the BB rating. It means when you get more debt and you cannot pay back as I went due, to reduce your credit worthiness. To threaten the BB rating, and you can see the BB rating, given an average business profile, the following rating guidelines apply. So the BB rating, the minimum interest cover based on that rating, and the default spread based on that rating is 0.5%. 0.5%. Now, 0.5% based on spread, basis period is what? 0.5% based on spread is what?
That's 0.005.
0.5.
Yes, you divide that 0.5 by 100. 0.5 by 100. You know, basis points, the formula is what? The formula for basis points, maybe for those that have not been in the class, the formula for you to get your basis point is what? When you want to get basis points, this is it. Or let me just show you this way. Let me say spread. For you to get spread is equal to, let's show the, to get spread is equal to basis points divided by 100 multiplied by 100. Spread is basis points divided by what? 100 multiplied by what? 100 over 1. So this credit risk is also known as default risk. So it is the risk that arise when a borrower is unable to make regular annual interest payments, and when you are unable to pay your principal at maturity. So as a result of default risks, investors will demand what? A higher return. That is, this return is what? Is your yield. And why are they demanding higher return? Is to compensate for defaults. Now, this spread, you talk about spread, you are referring to credit spread. This credit spread is the rates over and above the risk-free rates of return on government securities. The spread is the rates over and above what? The risk-free rates of return on government securities. So the spread is the difference between the actual cost of borrowing and the risk-free rates of return on bonds. So let's note this. So in one of our classes, I said, when you have 5 basis points, 5 basis points is what? 5 basis points is what?
0.05.
0.05. If you have 77 basis points,
0.77.
that is 0.77. You have 100 basis points, it is what?
1.0.
It's 1.0.
That is 1%. 1%. All these are in percentage. Let's take notes. They are all in percentage. And when you have 320 basis points, it is what?
3.2%.
So it is 3.2%. So this value in the question, where you have the value in the question where you have 0.5% default spread, the treatment will be what? The treatment will be what? Will be rate of return. It will be rate of return rate of return the value given in the question is what? 0.5% plus what? The value based on default is what? 0.005. These will give you what? These will give you what? 0.505%. Please add it. Is it giving us this? Yes, it should. When you have 5 here, it gives us. Now, what is the rate of return on a straight bond? The rate of return on a straight bond is what?
2%.
2%. Please check the question. You see it. That is the last item under the first table. So the rate of return, the rate of return on a straight bond. Straight bond has been explained. Solely bond without dilution. The rate of return on a straight bond is what? 2%. Now, to get the value of convertible bond, what are you going to use to discount your cash flows? To discount your cash flows.
1,000.
No, the discounting.
Sorry.
Since we are going to since the bond is for just 6 years, so we are going to use our rate of return, which is 0.55. 0.5. I don't mean the bond is to perpetuity, like you are not going to it is not going to be redeemed, so we can use the rate of return for the straight bond.
Okay. Any other view?
So I think we should use the interest.
The interest. That is, what value is that? So,
We add the two together.
which two, sir? Which value?
The rate of return and the straight bond.
So I was not adding these two rates that you calculated, this 0.05, 0.505, and 2%.
Okay. So we're not going to use it to discount, right?
Yes, sir.
Yes.
Okay. Now, the convertible bond is paying interest at what rate? The convertible bond is paying interest at what rate?
1%.
Very good. 1%. Now, similar bonds similar bonds issued by the company is bearing interest at what percent?
2%.
2%. Now, considering the fact that the bond, we want to see the value of the bond and not diluted bond. We want to see the value of the convertible bond. Yes, in relation to what the external market is, the value of the bond externally, what is the market value of the bond? Which rate of interest do you think is appropriate? Now, you are not just looking at, you have to discount based on the prevailing market value. And for you to discount, you discount using 2%. Now, you discount using 2% because of what? The convertible bond pays only 1% coupon. 1% coupon. But the similar straight bond is issued by the company, has what? 2% yield, and it's trading at par. So if we want to determine what the debt component of the convertible bond is what, we discount the cash flow at what? At 2%. 2% required rate of return on straight debt. So, for example, if we have 10 naira annual payment and we have 1,000 repayment, 1,000 repayment for investors, it is most appropriate for we to discount using what? Using the return on the straight debt, which is 2%. Which is 2%. So this 2% is what other similar bonds that have been issued by the company, is the rate of return on other similar bonds that have been issued by the company. So trading at par. Yeah. So the coupon on straight bond is 2%. So the appropriate discount factor or discount rate to discount our cash flow with is 2%. Is 2%. Because the rate of return of 2% on a straight bond is what is appropriate. Yes, I'm with you, sir.
Hello, sir.
Yes.
Well, based on your assumption, because one thing that you've initially said as the straight bond is that
Yes.
straight bond is the bond that's okay, it's going to be continually, like it's not going to be redeemed.
No, straight bond, we said is not
It's not
diluted.
convertible
Yes.
and it's not convertible.
Yes.
So when a bond is not convertible, it's like a form of like it's going to a form of dividend.
Yes, I'm with you.
To
Form of
the
dividend.
to the investor. Now this bond, now this one that the company uh has is that it have a interest rate of 1 naira. Why the one in the market is 2%.
Yes.
When a company gets a bond or a loan with a 1% compare the one that is, it means that the investment is favorable compared to the one of 2% in the market. So why are we comparing this using the higher interest rate to discount the bond that have a lower interest rate?
Yes. So this is it. This value of convertible bond, if you invest in a bond paying just 1%, if you invest in a bond paying 1%, but you receive additional conversion option, that is the trade-off. But when you are investing in a bond that is paying higher what? Higher interest, it means that the investor is not hoping to get what? Any conversion option. Now, looking at the question, your redemption value is what? Is it at conversion or at? So
It's at inception.
the redemption value is not at the conversion value. The conversion value is 800 as computed the workings above. So the 2%, is the bond portion where there is no dilution. Now, the redemption value is what? Is based on 1,000. So when there is dilution, what will be your redemption value?
When there is dilution, or we are going to use the free risk rates.
Yes, when there is dilution.
Yeah, when
So
there's no dilution, we use the coupon interest rate.
yes, the coupon interest rate. So since there is no dilution, the appropriate coupon interest rate, looking at the form of bond only, will be what? Will be 2%. Because the redemption is solely what? Seen to be what? Debt. And when there is no dilution, when there is dilution, it is debt plus what? Equity. Debt plus equity. But now that there is no dilution, the conversion value or the redemption value is still at our face value. We use our 2% to calculate what the debt portion of the convertible bond is worth. So, and that is why we are using 2% to discount the cash flows. Yes.
Adding me, our conversion value is 1,001 now. So we are going to use the risk-free rate, right?
Yes. Once the conversion value, if we are going with conversion value, definitely we'll use the risk-free rate. We're not going to use the 2%, to determine our cash flows. So I don't know if that is fine.
Yeah, it's clear, sir.
So our cash flows will be what? We have the year. How many years are we looking out for?
5 years. Yes, 6 years.
All right, 6 years. So we have details, can have values, can have details. I can say this is cash flow and my discount factor at 2%, my present value. So We are looking at year 1 to 6. So for year 1 to 6, your annual coupon is what?
10 naira.
Annual coupon is 10 naira. And your discount factor based on annuity will be what? I'm not mistaken.
5.601.
So your present value will now be what? That is 56 point
0.01.
56.01. So at redemption, the redemption value will be what?
1,000.
1,000. So your discount factor just at the 6th year
0.888.
this will be 888. So your value, the NPV or the present value overall will be what?
944.01.
So 944.01. So the value of the convertible bond is what? The value of is 944.01. So this is the value of the straight debt component. This is the value of the straight debt component. So this is what the A part of that question wants you to do. That calculates the value of the convertible bond. So, yes, what is your question, man?
Hello, Mr. Totope. I want to understand at what point do we use the risk-free rate?
The risk-free rate
To
is used.
discount the future cash flow.
The risk-free rate is used where you are working based on the what? On the conversion value, but it will be added to what? It will be added to the coupon value. It will be added to the value given in the question. That is, the risk-free rate is associated with the government bond. So where the question is telling you solely that this is a government bond issue, you use the risk-free rate also in line with that. So this risk-free rate in relation to bond is a default risk that you add to what? That you add to your spread. That you add to your spread. That you add to your spread. So the risk-free rate is used to determine your basis period. That is the basis period. So, but where the question have different values of risk, you use your risk-free rate plus your default spread to determine what? Your required rate of return. So the risk-free rate is added to what? To your spread. To determine required rate of return. And the required rate of return is risk-free rate plus what? Your default spread. So you don't just use the risk-free rate to discount directly. So you use the risk-free rate in relation to what? To your spread, to your default spread, to determine the rate of return, to determine the rate of return in a question. So as you can see in the question, we have the risk-free rate, right? But the risk-free rate is associated with what? In our workings.
The default spread.
Yes. We link it with our default spread to determine what? To determine the rate of return in relation to that. So based on the question, the risk-free rate will not be, or the rate of return in relation to risk-free rate and spread is not suitable to discount, but rather the straight line rate of return, which is 2%. So where we are considering the basis period, then we now come up with these values of our rate of return, which is 0.505%. 0.05%. So that is the A part. That is the A part. So the other part of the question is saying that what? Discuss why the convertible bond cannot generally be considered as a cheap debt. So why is convertible bond not considered as a cheap debt? Convertible bond. Why are we not seeing it as a cheap debt? Convertible bond. I discuss why the convertible bond cannot generally
Can I try?
be considered as a cheap debt. Yes. Yes. Convertible bond. Why is it not a cheap debt? It is not a cheap debt, one, because it comprises of what? It comprises of what? Debt and what? Equity. It comprises of what? Debt and equity. So since it comprises of debt and equity, it is not a cheap source of finance. It's not a cheap source of finance. So with this question, and give it financing advantage, yes. So the advantage of these sorry. So the point is the convertible bond should not be considered as a cheap debt, because when you issue convertible bond, the firm also sells what? Equity. Also sells equity, and equity is not a cheap source of finance. So with the element of equity, it makes convertible bond to be an expensive one. So that is A2, that computes the company's interest coverage ratio. Coverage ratio is a ratio under which form of ratio. Coverage ratio is a ratio under which form?
Gearing ratio. Is it gearing?
Gearing ratio. Gearing ratio. And gearing ratio is a ratio that investors will also be interested in. So to compute your interest coverage ratio, what will be the formula? The
Equity
formula
before
is what?
interest and tax. Equity before interest and tax all over interest expense.
Yes, all over interest expense. So based on the question, your equity before interest and tax is what?
2,200,000.
And your interest expense is what?
800,000.
So you can see free mark. Just looking at us, and that's why they gave it how many marks? 1 mark. So it's just for you to say 2,200,000 divided by what? 800,000. You have your answer. That is 2.75. 2.75. 2.75. The other part is how much money should be raised with the convertible bond issue in thousands of naira in order to avoid the threat of rating downgrade based on the quoted rating guidelines. So they are asking us that how much in thousands? How much in thousands? How much money should be raised with a convertible bond issue in thousands of naira in order to avoid the threat of a rating downgrade based on the quoted rating guidelines? So the question is, how much should we consider? So this will require a word problem. A word problem. Your coverage ratio is what? From your solution. To solve this,
2.75.
so the financial gearing at BB rating is what? At BB rating, when you check your question, that is the minimum interest cover at BB
2.3.
rating, 2.39. Your current expenses is what? Interest expense is what? 800,000. And your earnings before tax is what? 2,200,000. So they're asking you how much to be raised. This how much to be raised will be what? Additional interest expense. The additional interest expense to be raised. So for you to solve this, let me go back to my solution table. Let me go back to my solution table. What are we going to do? Now, based on your, I'm going to end the class very soon. Just once I talk about this, we'll end the class so that I will not encroach into your schedule. So the interest coverage ratio, the interest coverage ratio interest coverage ratio. The formula is what? Earning before that is EBIT divided by interest expense. Divided by interest expense. So from what we've solved earlier on, discovered that your interest coverage ratio is what? Will be 2,200,000 divided by what? 200,000 divide by the interest expense. The interest expense is what? 800,000. So the result here will be what? 2.75 coverage ratio. It will be in times. Now, the B part is asking us that how much addition is required. So the addition that will be required, it means we need more cost to be incurred. And what is that cost? We don't know. We can make that cost to be X. Now, based on the ratings, the financial gearing at BB rating is what? Is 2.39. So you want to know the additional expense in order to meet up with this interest coverage based on the rating. What will you do? It will be what? Earning before interest and tax, which is 2,200,000. 2,200,000 divided by what? The interest expense. The interest expense is what? Is 800,000. So for you to get the additional value, what will you do? You cross multiply. When you cross multiply, what will happen? You have it as 2,200,000 equal to what? 2.39 multiplied by 800,000. You have what? You have 1,912,000 plus what? 2.39 by x, that is 2.39x. So when you collect like times, what will happen? When you collect like times, the result will be what? You have it as what? That is 2,200,000 minus what? Minus 1,912,000 equal to 2.9x. And this will give us what? To get the value of x,
288.
you now, okay, 288,000. 288,000 equal to 2 points. I think this is 2.39. So equal to 2.39x. Divide both sides by 2.39 to get the value of x. The value of x will be what? The value of x will be what?
One 120,502.09.
120.09.
502.09.
So this is the additional interest expense. This is the additional interest expense on the amount to be raised. On the amount to be raised as 1,120,502. And the coupon rate will be at what? The coupon rate will be at what? The coupon rate will be at what value? In this case, will be at 1%. At 1%. So we can borrow to proceed to calculate the amount raised. So amount to be raised will be what? When the coupon rate is 1%. The amount to be raised will be what? This value here, divide by the coupon, will give you what? 0.01. This will give us what? Amount to be raised. This is the interest you have to pay. On this interest, how much will you raise that will amount to this interest? So
We have 12050,209. That's 12,050,209.
209. So for you not to be downgraded, for you not to get what you cannot pay, it is better to request for what? It is better to request for what? 12,050,200 naira. So the amount to be raised without causing downgrade on the existing BB rating is 12,050,209. 12,050,209. So because there must be a check on what you borrow as an organization. You can't just borrow anyhow. When you borrow and you cannot pay back, to affect your financial statement and it will reduce your rating in future. So as a guide, as a check for you not to borrow above certain limits and for you not to be downgraded, you consider these factors. The BB rating is a check to organization. The AA rating, the credit rating system, is a check to organization. The C part, that you should advise the company on the advantages of convertible. Sorry, let me switch to the page. That advise the company on the advantages of convertible bond for the companies on one hand and for investors on the other hand. Think you can discuss this. To the company, what are the advantages of convertible bond? To the investor, what are the advantages of convertible bond? Get it, though I've shown my own workings in a little different way on what is there. So you can also check for the literature, though our answers are same, but I've just decided to show some additional workings different from what they have there. So any question, please, before I end the class?